Welcome to Allodium's educational webinar on retirement income planning. Have you been thinking about how to generate a check a month from your investment portfolio when you retire? For most of our working lives, paychecks are deposited into our checking accounts on a regular basis, and then when retirement begins, those paychecks stop. And just like in the movies, the deep voice says, and then suddenly when retirement begins, the paychecks stop. That idea can be concerning to the average investor. Many investors want to develop a formal financial plan to forecast how their investment portfolio will generate a retirement paycheck to support their retirement lifestyle. We are often asked the question, how do we generate retirement paychecks from a broadly diversified long-term total return retirement portfolio? We have developed this presentation to help you to think about how to generate the monthly income that you will need to maintain your lifestyle when you retire. We have budgeted about 1 hour for this presentation. We will start with a formal 45-minute presentation by members of the Allodium financial planning team. And at the end of our formal presentation, we will set aside 15 minutes for a question and answer session. All of our webinar participants today are encouraged to submit your questions during the presentation. So as we go through our session today, please feel free to use the chat section in the Zoom application to ask any questions that you might have. We will plan to address all your questions in the formal question and answer session at the end of our formal presentation. This presentation is an educational presentation, and it is not intended to provide legal or tax advice. I'm David Brummelkamp, the President and CEO of Allodium, and I want to welcome you to our presentation on retirement income planning, how the bucket strategy can help. Our speakers today consist of 3 members of the Allodium Financial Planning Committee, Derek Van Callaghan, Saul Bauman, and Suzanne Tudor. Now I will turn it over to Suzanne to get our formal presentation started.
Hello, everyone. Most of us work our entire adult lives to reach retirement, our day of choice. We diligently save, we invest, we keep accumulating money until we and our financial advisors feel we have saved enough. Woo! We made it. Okay, now what do we do? How should we draw income to live on? None of us wants to make a mistake at this point in our lives. The truth is, there are several key strategies that financial advisors use as a way to draw income in retirement, like those listed on the slide. And we'll go over each of them and let you know the pros and cons of each. Then we'll go over what we feel is the industry best practice for taking income from your portfolio. Lastly, we'll look to the bucket strategy as a framework for understanding how risk and timelines factor into taking income in retirement. Every client we work with comes to us with their own unique take on how they plan to draw income in retirement. Some ideas turn out to be better than others. Think about your own plans as we go through this next section. When we learn about each strategy, there are several things to think about. Things like, how will this strategy affect my taxes? How do Social Security and required minimum distributions factor in? Should I avoid the market entirely and just go to cash? Will I be able to sell an asset exactly when I need the money? And do I really know how much money I need in retirement? And what about inflation? Lots to think about, so let's get started. I'll turn it over to Saul and Derek.
Thanks, Suzanne. When determining income needed from an investment portfolio, it's important to consider any additional sources of income. These can often include Social Security, pensions, and/or annuities. While these can provide steady income, you should consider if they have COLAs or cost of living adjustments. Specifically, Will they be able to keep pace with inflation? Another consideration is what happens to these income streams when you pass. Do they continue to support family, or do they just go away? When it comes to taking income from an investment portfolio, there are many more options and complexities involved. This is what we'll focus on today. You may have heard people express the idea that they'd like to live off the income and dividends of their portfolio while leaving the principal intact. In theory, this sounds like a great idea, but in practice, this approach alone can be problematic. For one, we've recently seen very low fixed income yields. This strategy may not be able to generate enough cash. Dividend yields have not been much better and are never guaranteed. In addition, taxes on dividends and interest can be at the higher ordinary income tax rates, so this strategy could be costly. Another source of portfolio income are capital gain distributions from mutual funds. This seems like a nice income windfall, but you'll owe taxes on these distributions. This can be a problem if gains are more than you anticipate and you owe additional taxes, or worse, if you owe underpayment penalties. Finally, investing for these types of returns can cause a portfolio to lack diversification and to end up with more volatility and risk. I'll now turn it over to Derek to discuss another income strategy that looks at more than just dividends, interest, and fund distributions.
Great, thanks, Saul. So instead of focusing on how much income an investment portfolio can generate, another strategy is called the total portfolio return approach. Total return means that you account for the capital appreciation of assets along with the income that is generated. For example, a standard portfolio of stocks, bonds, and alternatives might generate 3% of annual income in this current market environment. On a $1 million portfolio, this only equates to about $30,000 per year. An important component of investment assets is that their market value is expected to grow over time. A balanced portfolio might have a long-term annual expected return rate of 6% per year. Half of that return may come from income, while the other half is capital appreciation of the underlying assets. In order to capture the capital appreciation for retirement spending, it is necessary to sell the investments and realize those monetary gains for spending. Capital appreciation is actually the main driver of long-term returns in the stock market. The average dividend yield of the S&P 500 over the last 5 years is approximately 1.75%. This means that if you would have purchased an S&P 500 index fund 5 years ago and the S&P 500 price index stayed constant, you would have earned only about 1.75% a year on your investment. Now, in reality, over the last 5 years, the S&P 500 is up 84%, which equates to about a 13% a year total return. Over 80% of that return came from the capital appreciation compared to dividends. Now, if we take a look back over a longer time horizon, this chart shows the growth of $100 invested in the S&P 500 going all the way back to 1965. You can see that even accounting for the current market correction we find ourselves in, that $100 has grown to about $2,300. Most of this growth has come from capital appreciation of the stocks in the index and not from dividends. The bottom line is that if you're using the total portfolio return as a source of income, it can provide you with potentially more income in retirement. Also, capital gains tax rates are generally lower than taxes for dividends and interest. And there are additional tax saving strategies like tax loss harvesting that portfolio managers can employ. Now, one of the more famous rules in the investment industry is known as the 4% rule. What the 4% rule states is that in order for retirees to have a stable source of retirement income throughout retirement, they should only withdraw 4% of the portfolio value in the first year and adjust that amount by inflation each year going forward. This 4% rule was based on research done by financial advisor Bill Bengen back in the 90s. The goal is to maintain the purchasing power of the 4% withdrawn in the first year of retirement. Now, to develop his conclusion, he used historical stock and bond performance data between the years 1926 and 1976. He concluded that based on the returns from these asset classes during this time period, a 60% stock, 40% bond portfolio could sustain a 4% withdrawal rate over 33 years during any 33-year rolling period during that time frame. Nowadays, often advisors use the 4% rule as a static withdrawal rate to be conservative, as it serves as an effective rule of thumb to measure withdrawals against. Now, it's important to note some caveats to the 4% rule. Banking came up with a 4% number based off of a portfolio that could survive the worst 33 years of market returns. While some people may want to be conservative and plan for the worst, additional research done by Michael Kitces has shown that in most cases, a 4% withdrawal rate would cause the portfolio value to actually increase quite substantially over a 30-year time frame. The chart here came from Kitces' research, and it shows that the vast majority of time, the portfolio value is much higher after 30 years than where it originally started. This rule may not be advantageous for retirees looking to spend their wealth in retirement rather than growing or maintaining it. Also, the current market environment looks drastically different than it did even 20 years ago. We continue to be in a period with historically low interest rates, meaning that the expected return for bonds is nowhere near where it was decades ago when Bengen did his research. In his research, Bengen also only used a portfolio consisting of common stocks and treasury bonds in his analysis. In a rising interest rate environment like the one that we currently find ourselves in, where stocks and bonds are negative for the year, you aren't receiving much diversification benefit by investing in just these two asset classes. The good news is it's never been easier for individual investors to invest globally while also having exposure to alternative asset classes such as real estate, commodities, or hedge strategies. By investing in a portfolio that diversifies outside of just stocks and bonds, you may be able to receive higher risk-adjusted returns than just a traditional stock and bond portfolio. This may give you a better chance to sustain a higher withdrawal rate than the 4%.
Now that we know the key approaches used in the financial planning industry, we're ready to take a look at what we consider to be a best practice overall in the industry. We would sum it up as follows. The total portfolio return strategy provides the greatest flexibility and tax efficiency when taking withdrawals for income. It allows advisors to provide each client with an income stream tailored to their tax situation through an approach called asset location. For example, if you're taking required minimum distributions, you may not need or want additional portfolio income to pay taxes on. Advisors can locate income producing assets in tax deferred accounts to avoid increasing your income for tax purposes. Derek and Saul will provide more information on how this strategy works best in just a minute. The 4% rule provides a kind of test to see how an annual stream of withdrawals could impact the portfolio over time. This rule has been made into a software algorithm that financial planners can use to show clients how their portfolio may fare at various spending levels. We then recommend using the bucket strategy to help organize your wealth and mitigate risk. Dave is going to tell us more about how this can work for you later in the presentation.
So asset location refers to where an investment asset is held. Accounts can have three of the following types of tax treatment shown here on the graph: taxable, tax deferred, and tax-free. As shown here in the second column, taxable accounts are bank accounts and brokerage accounts. You do not receive any tax preference for contributions or withdrawals, and you must pay taxes on capital gains and income that are generated from these accounts. Highlighted here in the third column, tax deferred accounts are IRAs or 401ks. These accounts give you a tax deduction for the contributions and the assets grow tax deferred. The kicker here is that withdrawals from these accounts are included as taxable income, so they really aren't that tax efficient during the spend down phase of retirement. Lastly, tax-free accounts are Roth IRAs or Roth 401ks. You don't receive any tax deduction on contributions, but the assets grow tax-free and the withdrawals are tax-free as well, so long as you adhere to certain IRS guidelines. Tax-free accounts are the most tax-efficient accounts during the spend-down phase of retirement. Now, because these accounts all have different tax preferences, it's important to be cognizant of where investment assets are located. You want to put tax-efficient investments, such as passively managed equity funds, in taxable accounts, since they won't generate much income or capital gains relative to bond funds or actively managed funds. Now, on the flip side, investments that generate a lot of income, like bond funds, or have the potential for higher capital gain distributions, like actively managed funds, should be placed in qualified accounts, such as IRAs and 401ks, to shelter them from taxes. By being sensitive to where you locate your investment assets, you are provided a better chance to optimize your after-tax returns and therefore potentially your retirement income.
As each account has its own tax characteristics, it's possible to draw income from various accounts to tailor taxes to a client's situation. In a low tax year, it may make sense to make enough IRA distributions to fill up a tax bracket without going into the next higher bracket. Alternatively, you may want to keep income below a certain level in order to keep Medicare Part B premiums lower. At the same time, we're considering other tax strategies, such as tax loss harvesting and Roth conversions. Now that we understand some of the strategies regarding portfolio income, how does this income replace a paycheck in retirement? For many clients, it looks pretty similar to a paycheck. Once the income amount has been determined, funds are distributed from the portfolio on a set schedule or as needed. These funds can be directly deposited into a bank account. Advisors are able to monitor the cash levels and raise cash for the periodic distributions and any additional cash needs.
Thank you. The 4% rule has become a shorthand or rule of thumb to describe a methodology for taking income from a portfolio. Today, professional financial planning software has taken that basic methodology and greatly enhanced it to allow advisors to show clients what-if scenarios that could model what could happen to each client's unique portfolio over time. You may have heard of this as Monte Carlo simulations. These simulations start with your portfolio as allocated today and the annual amount you want to spend in retirement in today's dollars. Your expenses are then indexed for inflation from now until your projected end of life, just like the 4% rule. These programs then run algorithms with over 1,000 different iterations of various annual market returns to see how your portfolio fares. At the end, it gives us the probability that your portfolio will sustain your lifestyle through your retirement years. As you can see on the slide, 2 of the 3 scenarios will sustain your lifestyle at 99% or have a 99% probability of success. The example in the blue box shows that this client could start out spending more than they originally planned, $120,000 per year, with that amount going up each year for inflation, and still have a high probability of success at 94%. These what-if scenarios address the main concern with the 4% rule, which is that clients may restrict their spending too much in retirement when in fact they could spend more and still meet their goals. Conversely, if a client wants to draw more income than their portfolio appears to be able to support, advisors can look for strategies to help make the portfolio sustainable throughout retirement. These strategies will vary by client, but may involve spending less, saving more, working longer, or perhaps investing differently. These simulations help advisors help our clients and provide a check and balance when they're rerun each year to see where you're at. Next, we're going to turn it over to Dave, who will tell us about the bucket strategy as an additional tool for managing retirement income.
Thank you, Suzanne. What is the wealth management bucket strategy? This slide is a picture of a document that we created called the Wealth Management Bucket Strategy. And most of today's conversation has been focused on bucket 3, which is your long-term diversified portfolio. So what I'm going to do is kind of position this so you can think about other buckets that support your retirement income coming out of your total return portfolio. So what is the wealth management bucket strategy? The bucket strategy is a comprehensive approach to risk management, which includes all of the investable assets of an individual's net worth statement. In effect, this is a form of balance sheet management. A wealth manager provides comprehensive monitoring of all the investors' investable assets and helps investors to make the appropriate allocations between these various buckets. Determining the appropriate allocation is dependent on many factors and is unique to each investor's needs. Aligning your time horizon with an investment approach may help you to be more comfortable with maintaining a broadly diversified asset allocation in your long-term investment portfolio in bucket number 3. In the context of comprehensive financial planning, the wealth management bucket strategy is a wealth management strategy to organize your assets holistically, according to the various time frames and risk profiles. If you're interested in getting this particular document, we've got this as a handout that we can send to you, and it's also available on our website. Now, why should you care about the wealth management bucket strategy? This bucket strategy will help you to develop a comprehensive financial plan that will optimize the management of your investable assets. Who uses the wealth management bucket strategy? In essence, everyone uses this strategy, whether they understand it or not, because no decision is actually a decision. How you allocate between these 3 buckets is a decision that you make whether you know what you're doing or not. Now, most investors look to generate retirement income, usually developing a plan in bucket 3 as their broadly diversified long-term investment portfolio. They want an expected return of approximately 6 to 8% looking out long-term based on the expectations for future asset class returns. Derek talked about the 4% rule, which is usually applicable to drawing retirement income from this broadly diversified bucket 3 long-term investment portfolio. True wealth management looks at all the investable assets on your personal balance sheet and assigns these assets to different buckets based on both time horizon and investment risk. This is a little simpler version of the bucket strategies, just so we can focus on, keep our attention focused on this idea for a few minutes. Now, who uses each of the various buckets of the wealth management bucket strategy? It depends on the individual investor's personal preferences. Think about how you might be currently using investment buckets for your various investment assets. Bucket number 1, use liquid cash to buy something in the next few months. This is the liquid cash where you might need this money to pay the bills. Say to yourself, I may need this money to buy something in the next few months. This money cannot be invested in risk assets like stocks and bonds. You'll need to keep this money in some type of bank savings account, checking account, or money market account. Now, as money market rates have increased over the last 6 to 9 months, this is something you might want to look into to get a better return on your cash than bank checking and savings accounts. Currently, money market yields have risen to about the 2% range, which is a lot better than a year ago, but still below the historical average, over the past 50 years. Everyone has cash to invest, but not everyone is maximizing the yield on their cash. So you might want to take a look at the money market funds in bucket number 1. Bucket number 2 is liquid investments to buy something in the next few years. So say to yourself, I may need this money to buy something in the next few years. This is maybe money that you might need in the next few years. Typically, it's invested in short-term bonds. And I will go into a little example, an example of an investor like Ross Perot, who he had enough money to live on for the rest of his life without taking any stock market risk. So he had most of his money in tax-free municipal bonds. We'll get into that in a minute. That's bucket number 2. Bucket number 3 is, as I said, the liquid investments that you will need to fund your retirement income plan. Say to yourself, I'll need this money to fund my future financial obligations. This is the bucket number 3 is funding your check a month that you need to retire once you have quit your job and you need that monthly income from your portfolio. You need this portfolio to build the assets that you will need to generate that income you need when you're retired. And you will need to take investment risks in both stocks and bonds to grow your investment portfolio over the long term. Think about the rest of your life. You're not retiring for 1 year, you're retiring for the rest of your life. This is the bucket of assets that financial planners like Allodium will use to support a check a month retirement income in your retirement plan. The 4th bucket is illiquid investments that are not needed to support your retirement income plan. Say, I do not need this money to fund future financial obligations. This is typically aspirational money, or it's for investors who can afford to take risks in illiquid investments to potentially earn higher returns. This particular bucket, it's not applicable to everyone, but it is an opportunity, and some people do put more money into the 4th bucket. So how does the wealth management bucket strategy relate to retirement income planning? The bucket strategy is a tool that helps investors to organize their investable assets in a manner that allows them to be more comfortable with their long-term financial plan. Stock market is volatile, and as I said, bucket 3 has stock market risks, so you're going to have some volatility in that portfolio due to the stock market. If people have money in bucket 1 and 2 that has no stock market risk, it might allow them to be more patient with their long-term portfolio and give them a more comfortable emotional ride with their long-term investments. How is the wealth management bucket strategy used? The bucket strategy is a tool that financial planners use to help investors to manage the investment risks holistically, comprehensively, looking at the whole balance sheet. We believe that comprehensive financial planning requires an investor to take this holistic view of their investable assets. And we use this in the context of creating comprehensive financial plans for our clients. As we talked about with Derek's 4% rule on the total return portfolio, that bucket 3 is the total return portfolio. Every time we do an investment proposal for a client, we're going to include the financial projections on a total return portfolio as the foundation portfolio for generating that check a month for the client. So let's look at how to focus on these buckets in a different order. Instead of going bucket 1, 2, 3, 4, I'm going to go 1, 3, 2, 4. And the way I do this is, the first is you look at the first one and say, I need liquid cash that I'm going to need to pay the bills. Nobody argues with this because everybody knows that they need cash. So then the second focus is typically we go to bucket 3 and say, we're going to build a long-term investment portfolio to support retirement income. Almost everybody wants to retire comfortably. Almost everybody needs that third portfolio, which is the total return portfolio. And then a third focus is bucket 2. And there's a couple reasons for people to look at bucket 2, and I'll go into that in a few minutes, but that this is the maybe money that you might need in the next few years. And so when people say I might need the money in the next few years, some people don't have a need for this, but some clients will find this, or some investors will find this to be a very good vehicle to be thinking about in terms of managing their investment risk. And then the fourth focus here would be the bucket 4 aspirational money, which I said does not apply to everyone, but typically this is going to be an investment where someone says, you know, my brother-in-law tells me that he's starting a software company and he says it's going to be the next Amazon.com. And you decide you want to put some money into that investment. High risk, illiquid, might work. It might be the next Amazon, but it's not for everyone. So now next is I'll go into an interesting story about how a famous person looked at the various investment buckets. This is my story about Ross Perot. Ross Perot was a former presidential candidate. And when he first entered the national consciousness, he was a technology entrepreneur decades before he ran for president in 1992. He founded 2 technology companies that were bought for billions. His first company, Electronic Data Systems, in 1962, he founded it in 1962, and it provided outsourced IT services for companies as well as consulting. EDS went public in 1968, so Ross Perot owned a whole bunch of stock that was publicly traded. The stock took a major hit in 1970, and Perot lost more than $450 million on paper. How do you think that Ross felt after his portfolio declined $450 million? Just kind of think about that. You know, if you had a bunch of money and you lost $450 million. Now it's only on paper, so all your financial advisors are going to tell you you didn't really lose the money. It's all on paper, or don't read your brokerage statement. But the reality is $450 million loss on a stock portfolio. He must have felt bad about that. Later on, General Motors ended up buying the company, and he was completely out of the company later. And then he went and founded another company called Perot Systems. That went public in 1999, and Dell eventually bought that out for about $4 billion. Now, in 1992, when Ross Perot was running for president, the Federal Election Commission disclosure filings showed that of his multi-billion-dollar self-made fortune, it was the biggest financial disclosure form ever filed at the time. And he reported in this filing that he had extensive holdings in tax-free state and municipal bonds from Hawaii to Massachusetts. Now, he placed most of his assets in bucket number 2 because he decided that he did not need to take any stock market risk to reach his personal financial goals. So again, this is how he used bucket number 2. He didn't need to invest in the stock market to generate income for his retirement. So let's go a little bit into this bucket number 2, because most of our investors are really quite familiar with bucket number 1 and bucket number 3. So I'm going to spend a little time here trying to explain how this can be used. The most common purpose of bucket number 2 is that the investor's financial goal to use the money is for a purpose that is short-term in nature. It might be, people say, I might buy a lake cabin or a second home in the next few years. or I might start a business, so I might need this money to start a new business next year or in the next few years. They're not sure that they're going to buy a second home or start a new business, but it's a kind of want to have the money handy in case they make a decision to make a major purchase or, start a business. So that's like one of the main reasons that we see people funding this second bucket. The second important use of the bucket number 2 is related to behavioral finance. Placing money in a fixed income portfolio that does not have any stock market risk, it might allow the investor to be more comfortable emotionally with the bucket 3 portfolio that will have the stock market volatility. In theory, the bucket strategy might help a retiree from selling long-term stock market investments when the stock market is down. Investors might want to build a bucket 2 investment portfolio in conjunction with their bucket 3 total return portfolio. Say to yourself things like, I don't want to risk all my money in the stock market, and placing some money in the second bucket makes them feel like they're not, risking it all in the stock market. Or people will say, I sleep better at night knowing that I'm not going to lose all my money in the stock market. They won't lose all their money, they'll only lose some of their money. But that's what people are thinking. And the third is people might say, I want to keep my powder dry in case there's an opportunity to invest at lower prices and add into my bucket 3 when the stock market is lower in price or stock market has crashed, et cetera. Now, does bucket number 2 replace a diversified portfolio that is recommended to support your retirement income plan? No, this would be a complementary portfolio, supplementing your bucket number 3 portfolio. And does every investor fund a bucket number 2 portfolio? And the answer is no. This is an investment portfolio that you would work with your financial advisor as a piece of your overall comprehensive financial plan. And some people would say, how would a bucket number 2 fixed income portfolio affect the periodic rebalancing procedures in my broadly diversified long-term bucket number 3 asset allocation portfolio? And the answer is no impact. Your bucket 3 portfolio is going to be diversified according to your predetermined investment policy decision. So for putting this into a little bit more practical context, a year ago, interest rates were really low. And if people put money into the second bucket, it was typically just a placeholder for cash that people might need in the next year or two. It protected the cash from stock market risk, but it really provided no return because interest rates were so low. In the current rising interest rate environment, things have changed. And so current yields on short-term fixed income portfolios are very attractive relative to history. And treasury yields are now up in the 3.5 to 4-ish range. And it looks like every day the interest rates are going up a little bit more. And so this has really been a big transformational change in interest rates, particularly in short-term interest rates over the last 9 months. We now manage bucket 2 portfolios of short-term, high-quality fixed income investments that provide this targeted yield of, let's say, 3 to 4%. These portfolios are daily liquid. They are focused on investment grade, high-quality bonds with short duration. And we have the ability to invest in both tax-free and taxable bonds. We look at this bucket 2 fixed income portfolio as a great opportunity to provide better yields over bank CDs and savings accounts, which most investors have been using for the last several years. If you go back to Ross Perot and, you don't have to, if you have a couple $2 billion, you don't really need to go into the stock market to make enough money to provide your check a month. The bucket strategy can be used to manage investment risk. And we're not saying that no one should be in the stock market, because for most of us, we actually need that bucket 3 total return portfolio to meet our goals, our financial goals for the rest of our lives. but bucket 2 might be a strategy to complement your broadly diversified total return long-term bucket 3 investment portfolio. So now we'll turn it over to Suzanne to summarize today's presentation.
Thanks, Dave. We've gone over a lot of material today, and clearly there's more complexity to taking income than many people realize. Working with a financial advisor who has access to the best information and tools is strongly recommended. We hope one of your takeaways is that using tax-efficient, statistically driven projections to guide your income withdrawal stream will give you a high level of confidence that your portfolio will last throughout your retirement years and even provide the legacy you desire for your family. We hope another of your takeaways is that by using the bucket strategy as a framework, you can assume an appropriate amount of risk for your various cash flow needs based on your own circumstances and the amount of risk you need to take to meet your goals. I'll turn it over back to Dave, who will conduct the Q&A session.
Thanks, Suzanne. Now I'll ask the panelists questions from the audience. So to remember to submit any questions that you might have via the chat, Zoom chat function, not chat function, but the Q&A function. Couple questions I have for Suzanne. Question is, why do they call it a Monte Carlo simulation? That sounds like it comes from a casino, like playing roulette with our retirement money.
Great question. The Monte Carlo simulation was actually named after the gambling destination in Monaco because chance and random outcomes are central to the modeling technique. In retirement portfolio modeling, market returns are the random variable, just like throwing the dice. So the simulations that are run use a constantly different series of market returns to come up with an overall bell curve of potential outcomes. So once these 1,000 or so iterations have been run, it leads us to show the probability that the portfolio results will be positive in the end. So that's why you see the results referred to as X% probability of success when we run our financial plans for you.
Great, thanks, that makes sense. Here's a question that probably is for Derek. Derek, does the 4% rule still hold true if I retire right before a market decline, such as the Great Recession, or the market correction that we see ourselves in currently?
Yeah, Dave, that's a great question. And it's important to remember that, we get a market correction of 10% plus pretty much every year or two. So, I mean, we're going to have market corrections, and you're going to have a market correction as a retiree. Now, thinking back to the 4% rule and how it was created by Bengen, he looked at, 50 years of market history, and it included, things like the Great Depression. So let's say you were a retiree that retired in 1929. Disregard the fact that there weren't a lot of retirees back then because the life expectancy was about 60. But let's say you retired in 1929, and then 1930, you saw a stock market crash of 25. And then 1931 was another market crash of 43%. That's a pretty significant decline in your portfolio over the first 2 years of retirement. And, looking at Bengen's research, if you were to retire in 1929, before that, even sustaining a 4% withdrawal rate for the next 33 years, the portfolio would still have had money left over at the end of that 33-year time period. So, one of the bigger risks for retirees is called sequence of returns risk, which is exactly that. It's retiring before, say the Great Recession or a very major stock market collapse. In order to mitigate this risk, investors use, going back to what you talked about, Dave, the bucket strategy. So if a retiree can have, say 2 years worth of living expenses split between bucket one and bucket number two, and their portfolio drops 20, 25, 30%, instead of having to sell assets at a loss and pull money from the portfolio, they can either delay withdrawing from the long-term portfolio or take less and then live off of the assets that are in bucket one and bucket number two that aren't subject to equity risk.
Great. Thanks for that, Derek. Next one I have here is for Saul. The question is, if I want to lower my taxes, does it make sense to draw income from a Roth account?
Yeah, great question. So Roth distributions are tax-free, so they're definitely less costly than IRA distributions that are taxed at ordinary income rates. Now, when looking at sales and distributions from taxable brokerage accounts, it depends. So remember that when you sell something in a taxable account, you're only taxed on the gain portion. So for instance, you may sell something that instead of at a gain, it's at a loss, in which case you wouldn't owe any taxes on that sale. Also, some people are in a tax bracket where capital gains are not taxed, the lower brackets. And then we think of a couple other considerations. So oftentimes when thinking, should I reach for money in a Roth versus other accounts? A great thing about Roth accounts is you can oftentimes load those up with your more growth-oriented investments. And so a lot of people like those just to grow tax-free for as long as possible. Another consideration is Roth accounts are very efficient as estate planning tools. So if those accounts pass, beneficiaries of Roth accounts do not pay taxes on distributions either.
Great. Thanks for that, Saul. The next question is kind of a simple question, and I'm going to let all three of you answer this one. I'll let Suzanne go first, or I'll let you guys volunteer to see who wants to answer this one first. But the question is, what do you think of annuities? Who's my first volunteer?
It's a difficult question to answer quickly because there's a lot of different types of annuities. And I think there is a place for annuities for some people. They don't necessarily keep up with inflation, and they generally have higher fees associated with them because insurance companies need to make money off of the annuity investment. So I wouldn't say that there's anything terribly wrong or right with them, but generally, if a client is going to have an annuity, we recommend that it not make up the amount they invest in that annuity, not make up more than about 25% of their total bucket three.
Okay, thanks.
Yeah, that's a great point, Suzanne. And I'll add on to that annuities typically aren't as advantageous in low interest rate environments, because when you think about what an annuity company does is, they take your money that you put in an annuity and they invest in short-term fixed income investments. And if those fixed income investments aren't getting a high yield, then they can't in turn give annuity investors a higher yield. So, for the past, say 5-7 years when we've had historically low interest rates, they didn't really seem that advantageous, but that could be different as we're going into a higher interest rate environment, and there's more products out there being created from annuity companies. That could change, but like Suzanne said, certain situations it may make sense, but there are additional fees, less flexibility associated with them, but It's an ever-changing landscape for sure when it comes to annuities.
I just reinforce that we always pay a lot of attention to the costs of products like that. Oftentimes the fees, I wouldn't say they're hidden, but they're not obvious. So it's important to know what the upfront fees are, what the continuing fees are. They're oftentimes also very complex how they work. So many times they may follow the market somewhat, but perhaps the growth opportunity is limited. And then another thing I touched on in the presentation is what happens to the annuity when the owner passes. Oftentimes that money is just gone. And that's very different from an investment portfolio where you're able to pass on money to whoever you wish.
Great, Saul. That's a great point to make. So that's all I think I have for questions right now. So I think we'll close up and conclude our presentation for today. I want to thank our panel for the work they put into developing today's presentation. And I also want to thank all the participants for attending our webinar today. We hope that you found these ideas to be helpful as you think about retirement income planning. And please feel free to reach out to us if you have any additional questions about today's presentation. Enjoy the rest of your day. Thanks.